You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. And I just congratulate you for tuning in, particularly in the new year. It's going to be an interesting year post-pandemic, and there could not be a more appropriate guest for this episode than Jim Rickards. And I'm going to give you a little intro about him. I was first introduced to Jim by my friend Robert Kiyosaki. And Jim's a New York Times best-selling author. And Robert called me on the phone one day and he said, Andy, there's a couple of books you absolutely have to read for sure. And so there was a book called The Road to Ruin and The New Case for Gold. And these two books are the first two that I was introduced to Jim's work. And it was like having a front row seat to the Federal Reserve and how it changed with long-term capital management. So I'll give a little bit more of Jim's background and go along. We'll learn a little bit more about him. But Jim, thank you so much for being on the program. I've got 1,000 questions, and this is going to be exciting.
Well, you're welcome, Andy. It's great to be with you. And I agree with you. Robert Kiyosaki is a great guy, good friend of mine, and good inspiration to a lot of investors and readers. So anyway, I'm glad to be on your show.
So you're, by trade, you trained as an attorney, and let's fast forward, since in the interest of time, let's fast forward to long-term capital management. One of the most interesting parts of your book, and we're going to get to your latest book, the New Great Depression: Winners and Losers in a Post-Pandemic World. That's due to come out right away, and so, but in The Road to Ruin, you talk about the story of long-term capital management. And there's I don't know if it's a seminal moment, it's a pivotal moment where you're speaking with the Federal Reserve, from what you wrote in the book, I had a feeling like you were just saying, hey, there's going to be some ripple effects, when we have troubles here, because so many people, a liability on my balance sheet might be looked as an asset on maybe Goldman Sachs' balance sheet. And if I, default on that liability, they've lost that asset, so to speak. There's a big domino effect. And the Federal Reserve, began to change how they do things. Traditionally they'd buy bonds and government bonds. Now they started going to private. Could you just talk a little bit about your experience with that? I feel that was a very important moment in how the Federal Reserve changed and how they did things.
Yeah, I think that's right, Andy. It's a very acute observation. I'd be glad to talk a little bit more about it. The whole idea of too big to fail had been around for a while. It was around before long-term capital management. Long-term capital management happened, or that crisis happened in 1998. The firm was started in 1994. I was there from beginning to end, so I kind of saw the whole thing from the inside. But the idea of too big to fail really goes back to the 1980s and some big bank failures, Continental Illinois and some others. It's before a lot of people's time. I lived through all of that. So the idea that certain banks were too big to fail had been around for a while. But what was different about long-term capital is that the Fed now had to take that idea and apply it to something that wasn't a bank. Long-term capital management was a hedge fund. And we saw what was going on. I mean, obviously there was a massive failure of risk management there. We lost about $4 billion in about 6 weeks. But our view is, well, yeah, we know that. There were problems with risk management, but the accounting was very good. We knew to the penny what the mark-to-market was. But we didn't think we were going to get bailed out by anybody. That was the last thing we expected. The reason we called the Fed, we didn't ask for a bailout. We didn't expect a bailout. Our view was, you ought to know what's going on. We just thought we were being, we thought we were being good corporate citizens, because we knew, and you used the word ripple effect, that's exactly right. We had $1.3 trillion, not billion, but trillion dollars of derivatives positions, so-called swaps and other options and other kinds of derivatives contracts on our balance sheet. Well, every one of them was with a bank. We didn't do business with other hedge funds. We did business with the banks, and they were the biggest banks in the world. J.P. Morgan, Goldman Sachs, Citibank, Barclays, Barclays, Credit Suisse. You can go right down the list. And we did business with every one of them, about 50 banks in total. Well, if we had gone bankrupt or filed for bankruptcy or basically run out of money down to the last drop, as they say, good to the last drop, I always say we could have just slept in the next day. There was nothing else to do. But that 1.3 trillion would have been thrown back to the banks, because if you're a bank, you don't want to take an exposed position. You're trying to make a spread. You're a middleman. Yeah. So if we did, let's say, a $5 billion swap in French equities, French equity indices or Japanese government bond indices or whatever it might be, and the bank was the other side of that trade, which they were, the bank would have turned around and laid off the risk with their customers or other trading counterparts. So the bank they'd be long the position and short the position at the same time at different prices, so they'd be making a spread. That's kind of what the banking business is. Well, that's fine as long as both parties are performing. But when you take one of those parties out of the equation, which would have happened if long-term capital had failed, all of a sudden the bank's net short. I mean, if they're long to long-term capital and short to somebody else, and you take away the long, you're just naked. You're just net short a big number, as they say, in the tens of billions. Or if you're short, you're going to be long, whatever it might be. So what that means is that the minute long-term capital fails, all those banks have to run out into the marketplace and replace $1.3 trillion of positions to get back to a hedge position. Well, the market's not that big, not all at once, not all in the same day, not every bank trying to do the same trade. And it goes beyond that because, Japanese government bonds and foreign stock indices, et cetera, but we were the largest risk arbitrage firm in the world.
Right.
And no one knew that. Everyone said, these guys trade bonds or whatever, so what? But we had stock positions. We stayed at 4.9% because when you go to 5%, there's a reporting obligation. Well, we were compliant, but we stayed at 4.9%. So we're kind of flying under the radar screen. We did it in derivatives, not actual stock. The stock was owned by our brokers. But we were in all the big deals at the time, Lockheed, Boeing, Citibank Travelers, you go down the Salomon Brothers, you go down the list of MCI WorldCom was another one. You go down that list, we were in every one of them. So we called the Fed and said, look, you ought to come up here and talk to us just so you know what's going on. But as I say, we weren't expecting bailout. Well, they came up on a Sunday because time was of the essence. It was Peter Fisher, who was the head of the open market desk, and a guy named Gary Gensler from Washington, who is the assistant Secretary of the Treasury, and one of Peter's assistants, a guy named Dino Cost, really brilliant analyst. Well, they sat in a room. It was with John Merriweather, who is our CEO, and me. So the five of us sat in the room, and we had printouts, and we just spent hours, 5 or 6 hours, turning pages saying, we got this, we got this. When we were done, Peter's face was white. He said, I knew you guys could blow up the bond market, but I had no idea you could blow up the stock market also. In other words, if we had failed, and we were probably just days away at that point, it was going to close every market in the world. You're going to start in Tokyo, shut the Tokyo Stock Exchange, go to Singapore, France, London, New York, and around the world, every exchange would have closed because they couldn't have handled the efforts of the banks to try to replace all these positions all at once. And so they said, we have to keep you guys afloat because it's not about you anymore. It's about shutting down all these banks and all these exchanges, basically shutting down global capital markets. That's how bad it was. On the other hand, they had a political constraint, which was, hey, the Fed can't give money to a hedge fund. That's impossible. So what they did, and this is our pattern for this, by the way, we had a playbook. It was the panic of 1907. That's when J.P. Morgan rescued the financial system, which was collapsing in New York. But you had to go back to 1907 to find something comparable. And what the Fed did, they got everybody in a room. Same thing, Pierpont Morgan did in 1907 at his townhouse in Murray Hill in Midtown Manhattan. And they said, the Fed said to the bankers, you guys have to figure this out. The Fed's view is, our hands are clean. We bought you the Cokes and sandwiches, but we can't write any checks. You have to do it. But we're telling you, and I've been on the banking side of the business. I've had a lot of dealings with the Fed. When the Fed tells you to do something, you do it. If you're a bank, you just do it. You don't fight
unless you're are Bear Stearns and Lehman, right?
Well, Lehman actually, to give them credit, Lehman was always the weak link. And interesting, when you go ahead to the 2008 financial crisis, I knew that Lehman would fail because I knew they were going to fail in 1998.
Yeah.
Lehman was always the weak link, and anybody on Wall Street knew that. The world didn't know it. The average investor didn't know it. Nobody in Washington knew it. I told the John McCain campaign, I said, in August, I said, get ready. I was an economic advisor to John McCain, and what happened there? This is now August 2008.
Yeah.
The government bailed out Fannie Mae and Freddie Mac, and the McCain team were high-fiving, like, okay, the financial crisis is over because they bailed out Fannie Mae and Freddie Mac. So now we can get back to talking about the Iraq War because that was McCain's strong talking point because he was a hawk. And I said, no. I said, this is not over. I said, you are not going to make it to Election Day without a bigger form of this crisis, another blow-up. So you get ready for it now. Here's what you need to do. I was laughed off the call. I was not invited back. They did not listen to my advice. If they had, McCain might have won the election. But you knew that Lehman was the weak link. But anyway, go back to 1998. What Lehman said, it was supposed to be 16 banks at $250 million apiece, which would add up to $4 billion. That's how much was needed. And what Dick Lehman says that we can't do 250. We can do 100. But they were stretching to get the 100 million. And Bear Stearns backed out completely. That's another whole episode we don't have time for. But they were acting in complete bad faith. By the way, when Bear Stearns failed in 2008, no tears were shed.
No, I mean
Wall Street has a very long memory, and they were, as far as people were concerned, Bear Stearns did not stand with Wall Street in 1998, so they were hung out to dry in 2008. There's an old Italian saying, revenge is best served cold.
Yeah.
Revenge is a dish best served cold, and it took 10 years, but Bear Stearns kind of got what was coming to them. Yeah. So that's Wall Street. But Peter went back to New York, called the heads of the four biggest banks. It was Goldman. It was John. John Corzine was the CEO of Goldman at the time, later governor of New Jersey. Sandy Warner at J.P. Morgan, Dan Tully at Merrill Lynch, and a couple others. And they sat down, and then they expanded the group. And by Wednesday, we had a term sheet. But by then, they had moved over to the Merrill Lynch boardroom. They got out of the Fed as fast as they could. They had their marching orders, but nobody wanted the Fed's fingerprints on it. But the short answer to your question is, that was a turning point because it meant that too big to fail was no longer limited to banks. And today, of course, we see they've got 14 programs. The Main Street lending, they guarantee the commercial paper market, they guaranteed the corporate bond market, they guaranteed the junk bond market. So the days when the Fed was limited to helping banks are long gone, but that was the turning point.
I'll let people decide politically their own views on whether that's a socialist move or a capitalist move. I mean, I lean towards, in capitalism, you're going to have failures. It's part of the process of competition. If you go out and you get over-levered and you become tremendously aggressive in your leverage, and, someday you mess that up, you get hurt. But as socialists say, but too many other people get hurt, so let's bail them out. And so we'll leave that for the political pundits to discuss what they think about that. But the point is, now the Fed, that began, like you said, a moment where this behavior began to grow. And in 2008, now you have them buying, you have the toxic asset program where they're starting to buy private things instead of public things. Right. And you have Japan. The trend is, can you imagine what would happen to the stock market if now they pump money into equities? And what's interesting is, which equities do you buy? You bought the worst assets in the world to clear the balance sheets of toxic assets. If you're a guy on Wall Street and they say they're going to start buying equities, if you're not buying equities, you're going to lose your job, in my opinion, because that would just, that. So what I'm saying is with the amount of money they're printing, and I think this has a lot to do with your book, The New Case for Gold, that the amount of money they're printing, there's just this seemingly detachment from fundamentals. I look at the stock market today, I have a hard time believing we're fundamentally stronger today than we were a year ago. And as you grow the amount of currency, it's harder to move it. And so we'll see the velocity of currency. I know you've talked a little bit about this, but maybe we can have you talk about the velocity of currency. If I have a river and I pour more water into a river, that's going to speed up the currency. It's going to go faster. But if the river turns into an ocean, it's tough to keep the velocity going because of the sheer number of dollars that have been printed. Could you talk a little bit about our two extremes we have? We have an extreme in the amount of money in the system, currency, but then we have also an extreme in I don't think they've measured it back past the 60s. We have the slowest movement, the velocity of money, measured how a dollar moves per quarter is at an all-time low. Could you talk about that?
Sure, and I talk about this at length in Chapter 4 of my new book, The New Great Depression, Winners and Losers in a Post-Pandemic World. But we go into this topic in depth, and it's the reason that monetary policy won't work or doesn't work. The Fed keeps coming out saying we're going to keep interest rates at zero until Jay Powell said 2023. I have news for Jay Powell. They're going to keep them close to zero until 2043. But that's a separate topic we can get into. But and they've taken their balance sheet. I mean, in coming out of the global financial crisis of 2008, the Fed balance sheet went from $800 billion to $4.5 trillion. Today, it's closer to $7.5 trillion. So they've printed $3 trillion, not billion, but trillion, of new money since the COVID pandemic, really since the around March. That's right, at the end of the first quarter of 2020. Now, the Austrians and the monetarists and the people who follow Milton Friedman and even the neo-Keynesians have all said, well, when you print that much money, you're going to get inflation. Not true. That's not how inflation works. Money supply has almost nothing to do with it. We've had low inflation, occasional, close brushes with deflation for 13 years. I mean, how many years do you have to be wrong? Money printing does not cause inflation. What does cause inflation is velocity. And here, one way to think about it, think of money printing as piling up wood. Well, you can pile up all the wood you want, but if there's no spark, no match, no bolt of lightning or ember or campfire or something to set it off, you're not going to get the inflation, which is the fire in my example. Mm-hmm. So the question is not how much wood have you piled up. That doesn't matter. What matters is where's the spark, and that's velocity. And here's a simple way to understand velocity. It's the turnover of money. Yeah. Basically, the formula is GDP divided by money supply, and that number is 1 or 1.5 or 2 or whatever it is. That's the velocity of money. But just to kind of put it in everyday terms, let's say I go out to dinner and I tip the waiter, and the waiter takes her tip and takes a taxi cab home and tips the taxi driver, and then the taxi driver pulls into a gas station and puts gas in his taxi. Okay, in that example, my dollar had velocity of 3. There was the tip for the waiter, the tip for the taxi driver, and the gas at the gas pump. So there were $3 of goods and services that came out of $1 of money supply. So velocity in that example is 3. But what if I stay home and watch TV and I don't go out and I don't spend any money? The velocity is 0 because there was no turnover of the money. And I remind people, calculus has its place, but a lot of this is just 5th grade math. $7 trillion times 0 is 0.
Yeah.
Meaning, if you don't have velocity, you don't have an economy. So don't worry so much about the 7 trillion. They can make it 10 trillion. They probably will. Focus on the velocity. Well, the news there is velocity has been declining since 1998. Now, it went down more steeply in 2008. It went down steeply again in 2020. But there's nothing new about the decline in velocity. The causes of the decline in velocity are much more profound. It has to do with demographics, technology, retirements, reduced labor force participation. There are increased savings. There are a lot of reasons for it, but those reasons predate the crises and are bigger than the crises. But the point is they're continuing. Velocity is still dropping. Everyone's like, well, is it hit bottom yet? Is it going to turn around? The answer is no. You can think of what the Fed is doing as a desperate struggle because the equation for nominal GDP is money supply times velocity. Well, velocity is going down.
Yeah.
Well, if you want to maintain nominal GDP and certainly real GDP, and velocity is going down, you better increase the money supply. But the increase in the money supply has just been enough, barely, to offset the decline in velocity. So you're not going to get inflation until velocity increases. And that is a psychological concept. It's behavioral. It's how do you feel?
Yes.
Do you feel prosperous? Do you feel...
Do I have a job? Because if I don't have a job, I'm not going to spend as much, right? I mean,
that's correct. But even if you do have a job, you might be worried about losing your job. In other words, that's what they call precautionary savings. Like, okay, I still have my job, but my neighbor doesn't, and my spouse doesn't, and maybe I'm going to get fired next week, so I'm going to save more just in case. And that does show up in the data. Savings rate is skyrocketing, and that's why these checks, and we can get into fiscal policy, deficit spending. These checks that they're sending out, it was $1,200 last April, I believe. They approved $600. There's a debate in Washington about whether it should be $2,000. I'll leave that to the politicians. But whatever it is, they say this is stimulus, and we give the people the money, and they're going to spend it. They don't spend it. They pay down debt, which is a good thing, but that's just shrinking your balance sheet. That's not when you pay down debt. It's the same as savings. You're not spending the money. You're shrinking your balance sheet, or they are saving it. Now, what a lot of people are doing, this is interesting, is these, I don't want to pick on millennials, but, younger people maybe not that experienced in the stock market, they're getting the money, and they're like, well, okay, I'm not going to spend it because I'm worried about the economy, but I can't go out because of the quarantine. I can't spend it if I wanted to because I'm locked down. They're investing in the stock market, which sounds like a good thing, but they're all on Robinhood.
Yeah, I was going to say, Robinhood had record accounts opened after that first stimulus check, and people are killing themselves because they don't know how to read their statement, right? I mean, that's how ignorant they are.
There's at least one suicide for that reason. Somebody had a big, I believe it was a $700,000 deficit, but there was a credit of comparable amount. Maybe there was a small loss, but it wasn't $750,000. But the guy saw that and said, and by the way, even if you do see that, just close the account and file for bankruptcy. You don't have to kill yourself. But the point being, bear in mind, this is a generation that grew up on video games. And when they get the Robinhood screen, I'm picking on Robinhood, but they are the leading culprit here. When they get the Robinhood screen, I mean, I look at it as a trading screen. I have trading screens, open right now. But this generation thinks it's like a video game. And it's kind of got colors and flashing lights and arrows, and it looks like a video game. And for them, it's just gambling. And they were buying Hertz. I mean, Hertz filed for bankruptcy. They were actually in bankruptcy.
Yeah, unbelievable.
And the stock went from about $2 to $6 a share because it kept going up. And if you bought it at $2 and it went to $6, you tripled your money. Now, you tripled your money on a bankrupt company. It's not going to end well, but hey, if you sold it, you walked away with the money, and some people did. So it's a little bit crazy in that sense. But the real bottom line is there's no velocity. If you want velocity, you have to change the psychology. And I talk about this both in Chapter 6 and in the conclusion of my book, The New Great Depression, how you can do it. The Fed actually doesn't know. And what I explain to the readers is, look, here's how the Fed could solve the debt problem. By increasing velocity, you actually need inflation. I'm not saying inflation is a good thing. What I'm saying is that it's going to be inevitable because with this, we cannot sustain this much debt. We can't. But what you can do, it's kind of like an ice cube melting in your hands. You can make the real value of the debt go down. The nominal value of the debt, I'm talking about the national debt now, which is about $22 trillion. The nominal value is always going to be $22 trillion. But if you get, say 4% inflation for 17 years, the real value is cut in half because the value of the dollar is cut in half. So you're paying it back with cheaper dollars. So you actually need a little inflation to get out of this. And it's exactly what the Fed did in the 1950s and 60s. It got out of control in the 70s. But in the 50s and 60s, it was like clockwork, and the debt-to-GDP ratio just kept going down. Well, the Fed has forgotten how to do it, if they ever knew. But I remind them in the book, and I give two historical examples, two presidents in the 20th century who actually did this, both of them not economists, but they were smart enough to know how to do this. But what I say to the readers, Andy, is even if the government doesn't do it, you can do it. You can personally protect yourself against the inflation and kind of do what you need to do, even if the government doesn't. So there's some good, I think, practical advice in there as well.
So let's talk about a little bit more about the new Great Depression. And this is an important subtitle, Winners and Losers in a Post-Pandemic World. The timing's tough. You look at, the Big Short, where these guys decided to create insurance contracts when mortgages failed. Well, a lot of those guys look like geniuses where they might not have been because they had the timing right. There were probably a lot of people that tried to do before it, maybe people that planned to do it after it, and those guys happened to be lucky with the timing, or maybe they were geniuses. But with these problems, right now you have, I'd love to see you and Stephanie Kelton in a boxing ring together. That'd be kind of an interesting conversation.
Well, I got a little reach. I know Stephanie. She's a very nice lady. I got a little reach on her, but she's a big brain. Stephanie's a professor at State University of New York in Stony Brook, and she's the big brain, the leading intellectual light of modern monetary theory.
Yeah.
She has a book that came out fairly recently as well. So we've met in person, very nice person, but we disagree. She won't debate me. I've challenged her a few times, but maybe that'll happen someday.
Well, it would be an interesting thing because she's just going to say, look, we have the power to tax you, and that's going to keep the money solvent. And as long as we are in charge of printing these pieces of paper, but also have the ability to require them from you under threat of prison, then we're going to be fine. So let's talk about the winners and the losers. If I'm listening, there's a lot of people who are either Chicken Little or Paul Revere often say. There's so many people that make their living saying, well, the sky is falling, the sky is falling, the sky is falling. And it gets people's attention, and they try to go out and sell a book. There's another scenario where maybe it's Paul Revere, where we say, look, we have some data. We have a monetary policy that is they're gaining more power and influence, and really the more power they use, the less they have, if that makes sense. In other words, the more they use the shovel, the deeper the hole they dig themselves. And Jerome Powell, that's got to be a tough job right now because he's doing things that he feels he has to do more than things that he'd like to do. And then on the fiscal side, you mentioned the 22 trillion we've written in bonds. Well, think about the 100+ trillion we owe in promises, that are unfunded liabilities that we have not funded with bonds. And so when does this come to a head? Japan, Stephanie Kelton would say, well, Japan has a debt to GDP of 250 plus for, how many years now? No inflation there to speak of. When is it 2021? How do you get the timing of something like this, where the system becomes so strained that the Fed can no longer, where it's no longer too big to fail, it's too big to bail?
Well, I talk about that in the book. I don't consider myself Chicken Little or Paul Revere. I consider myself an analyst. So I think that people who make claims, big claims, the sky is falling or the whole system's going to collapse or we're going to be buried by inflation or the converse, it's all under control or, Stephanie Kelton's like, what's the problem in Japan? Yeah, I never make claims like that without giving the analysis and evidence to back it up. And in chapter 6 of my book, The New Great Depression, I do talk about specific winners and losers. I do talk about specific investment strategies, asset allocations for investors. But before I get to that, I describe my analytical method. I want to say, look, here's how I do it. Here's how you can do it. And what I say is that you can there's sort of three factors. You have to know kind of what's coming. You have to know what the policy response is. So don't just ask yourself, oh, is this bad or good? But say, what is the government going to do about it? Because if you don't think about the policy response, you're going to get run over by an 18-wheeler. And then finally, you get to the timing of it, and that is more difficult. But I have a methodology. It's a technology I've developed myself, along with some collaborators, and it works extremely well. So we do have a sound method for doing this. So a couple points I would make. Number one, Stephanie's right. Professor Kelton is right that Japan hasn't had inflation. In fact, they had the opposite. But they've also had 30 years of slow growth.
Yeah.
I remember in the 90s they talked about the lost decade. Well, try 3 lost decades: the 90s, the early 2000s, and the 2010s. So now they're now entering their 4th lost decade. The United States is entering its 2nd lost decade. That's what a depression is, and that's the difference between a depression and a recession. And I explain that in the book. So first of all, if you want to be Japan and go 30 years with occasional technical recessions, a long depression, no growth, good luck. I'm not sure that's a great outcome and not one that Americans are willing to accept. But beyond that, a lot of the things they build slowly, and then they happen all at once. So in the build slowly stage, you can see them coming if you're using the right method. And so when the shock comes, you could be ready for it. I'll give you a concrete example just to make the point. And most, I think, of your listeners, Andy, would be familiar with the Weimar Republic hyperinflation in Germany in 1921, 22, 23, when the Reichsmark went. There comes a time when you stop calculating it. It was like pennies on the dollar. Well, it was like thousands or millions of a penny to the dollar, et cetera. It completely collapsed. But there was a guy in Germany named Hugo Stinnes, and what he did, he borrowed massively in Reichsmarks, that was the currency of the time, and he invested in hard assets. He bought coal mines, he bought steel facilities, he bought vessels, he bought transportation assets. It said all hard assets, coal, steel, factories and transportation assets. And then he just waited. And then, of course, the Reichsmark collapsed. So he turned around. He paid off all his debts. Of course, he's paying, with jelly beans, right, because it's worth it. Yeah. Paid off all his debts, kept the assets, and was the richest man in Germany. And his nickname at the time, my German's not good. Actually, I don't speak German, but it was Inflationskönig, which means the inflation king. He became the richest man in Germany because he could see it coming, and he took the right strategy. So Joseph P. Kennedy is another example. He spent the 1920s, ramping stocks with a gang. It was Big Mike Meehan and Joe Kennedy and a couple others. And they would bid up the stocks and get all the suckers to come in and buy them, and they would dump them and walk away with their profits. But when the stock market crashed in 1929, he was short the stock market, so he made another fortune, and he was one of the richest men in America in the early 1930s after the crash, during the Great Depression. So my point is, even in extreme financial conditions, extremely adverse financial conditions, such as the Weimar Germany hyperinflation or the U.S. stock market crash in 1929, you can still get rich. You can get immensely rich, but you have to see it coming. You have to understand the dynamics, and you have to know what to do. And I do talk about all of that in the book.
I'm going to tell people your website's James Rickards Project. That's jamesrickardsproject.com. And, of course, the book they can get on that Amazon, I assume.
Yeah, it's available on Amazon, Barnes & Noble, and it'll the publication date is January 12th, but it's available for pre-order anytime right now.
And I'll tell you, the reason I recommend getting books like this, whenever I bring a guest on, it's for educational purposes. And, Jim mentioned, the Robin Hood millennials, all these guys. I think the average account size at I don't know what it is for Goldman, but at Robinhood, it's like $2,000. Okay, they got all these people, very little money, very little education, and you mentioned that debt is probably the greatest investment you have with inflation by far. It can go the other way. People in Poland, they're earning zlotys and they're borrowing in Swiss francs. All of a sudden, they unpeg the Swiss franc, and their mortgage is 20% more difficult to pay off. Because they're earning zlotys instead of francs. And so my point is there is a culture of advice on Wall Street. The most important letters on Wall Street are AUM, assets under management. That's their gig. It's getting more assets under management, more of your money that they can have, and more fees they can charge. And without financial education, navigating the post-pandemic world, you're going to be impacted upon rather than being able to act. And I think that it's not just the new Great Depression. I really struggled to read The Road to Ruin simply because it was, it's a tough read. It's an intellectual book, and here we have a guy, from Johns Hopkins, New York University, economics, all this, talking to a broken down basketball player like me. So, but it was worth the effort for me to be in a study group, to get my investing friends together and go through the new case for gold, to go through the road to ruin, to go through, as we will, the new Great Depression, so we better understand how, GDP is just velocity of money. And, another point is, in your example, every time that money changes hands, that's where tax revenue comes from. If the money doesn't change hands, there's no taxable event. So learning these types of things in a post-pandemic world, which also impacts the velocity of money. Obviously, if there's no football game to go to, that money either stays in my pocket or saves or goes somewhere else. If I'm not going out to the restaurant and I'm buying things at the grocery store for 1/10 the price, less money moves. Technology, you mentioned. This is an important book for 2021 in terms of your financial education. Hey, I've read Stephanie Kelton's book, doesn't mean I agree with it, but I'm going to read as much as I possibly can. I'm going to listen to people like Jim, listen to people like Robert and the other guests I have to get ready for 2021. Final advice, I hate the culture of advice. Maybe a lesson people should seek to learn going into this new year as we close, Jim.
The answer is you're not helpless. There are things you can do, and some people say you can't forecast the future. That's nonsense. You can forecast the future. You just need the right models. And when I say you forecast the future, what you're really doing is you're looking at today. The future is embedded in today. There are things going on today that you can see, that you can measure, that will tell you what's going to happen next. But you just have to know where to look and how to measure it. So don't throw up your hands. Don't curl up in a ball. Read the book, The New Great Depression, and it will tell you specifically where things are going. I had a book in 2019 called Aftermath, and on page 290, and readers or listeners who have it, go look at page 290, 291. It says the odds of a pandemic in the next several years are 100%. And it goes on to say there will be riots in the street, armed mobs in the street. This is in 2019. So there's nothing that happened in 2020 that you wouldn't have seen coming if you had read my 2019 book. Likewise, if you read this new book and you want to know what's going on in 2021, 2022, the book will tell you.
I've always said policy and demographics will give you the future. You just look at how many people you have, their age, what they're doing, and then look at the policy. You'll get a good idea just right there. So, Jim, thanks you for your time. It's been a very interesting journey for me to become a student of yours and read your books. As I say, they're not for they're certainly not light reading. I mean, they are really filled, as you say, with data, and they're very in depth, and so it's a great challenge for people to take on. Last time, the book is called The New Great Depression: Winners and Losers in a Post-Pandemic World, available on Amazon. And you've been listening to the Cash Flow Academy. My guest has been New York Times bestselling author Jim Rickards. We hope that we can be a resource to you to help make things more simple for you. Until next time, this is Andy Tanner wishing you a great new year. We'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.